Are there still lessons from 1970s inflation for today's commodity investor? Imagine a time when prices for everything from oil to wheat doubled and tripled in just a few years. That was the 1970s, a period of intense inflation that changed how investors viewed commodities. Today, understanding what happened then can help you see what might happen now. Back in the 1970s, inflation soared from about 3% in 1970 to over 11% in 1974. By 1980, it had climbed past 14%. This spike was caused by the end of the Bretton Woods system, which had linked the dollar to gold, plus loose monetary policies that flooded the economy with more money. When confidence in paper money dropped, investors looked for assets that could hold their value, especially commodities like gold, oil, and agricultural products. One key lesson is that monetary policy has a big impact on commodity prices. When central banks increase the money supply and inflation expectations grow, commodities become more attractive as a way to protect wealth. Today, if central banks start easing or tightening policies, it can influence commodity demand and prices. Watching how they act helps you anticipate market moves. Geopolitical events also played a major role in the 1970s. The Arab oil embargo in 1973 and the Iranian Revolution in 1979 caused oil prices to nearly triple. These supply disruptions pushed prices higher because actual shortages appeared. Other commodities like wheat and corn also shot up because of global demand surges and low stockpiles. This shows that real supply and demand issues still matter today. When tensions or disruptions happen, prices can spike quickly. During the 1970s, markets also became driven by investor psychology. Rising prices created expectations of more inflation, which led to even more buying. Easy credit and futures markets amplified this effect. Copper, aluminum, sugar, and other commodities saw prices rise well beyond what supply and demand alone would justify. This pattern warns investors to stay disciplined and avoid chasing rallies that are based only on hype rather than fundamentals. Gold performed remarkably well during this period, returning about 9.2% annually after adjusting for inflation. The broad commodity index, which includes energy, metals, and agriculture, gained over 586% in total. Meanwhile, traditional investments like treasury bills, government bonds, and stocks struggled to keep pace with inflation. This shows that commodities can serve as good hedges when inflation is persistent and driven by monetary factors. Government policies also played a role. Nixon's wage and price controls from 1971 to 1974 temporarily slowed inflation but caused shortages. When controls lifted, prices surged again. Export restrictions and tariffs further distorted markets. These actions created opportunities but also added volatility and unpredictability. The market finally cooled when the Federal Reserve, led by Paul Volcker, raised interest rates sharply starting in October 1979. This broke the inflation psychology and brought prices back in line with supply and demand. It reminds us that no commodity rally lasts forever. When central banks tighten monetary policy, inflation expectations drop, and prices often fall sharply. For today's investors, the main takeaway is to keep a close eye on monetary policy and inflation expectations. When money supply grows and inflation rises, commodities tend to perform well. But when tightening begins, it's wise to be cautious. Remember, fundamentals like supply and demand still matter, even when markets get emotional. Commodities can diversify a portfolio during inflation, but their success depends on the economic environment. Be disciplined and watch for policy shifts that could change the game. The 1970s showed us that inflation, geopolitics, and investor psychology all work together to drive commodity prices. Knowing these factors can help you make smarter decisions now.